Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Macy's is down 1.5%. I was looking to see if there was anything that came out recently, and it hasn't. So I just wonder if, it had a nice run up into earnings. We're still just a few months away from 52-week high. Maybe it's that. But we want to get more insight on to that. Yes, raising a full-year outlook, good. Same-store sales falling less than estimated. Rachel Ten Brink is general partner over at Red Bike Capital. She joins us now in studio. Rachel, you deeply cover the retail industry. What was your broad takeaway from Macy's?
So I think that there's a new CEO. The clock is ticking. There's a lot of pressure. And so I think that he's trying to, as quickly as possible, make an impact. But truly, it's hard to see the short-term sort of real pop. I think what you're seeing is there's a lot of focus on top doors. There's a lot of focus on top performers in the Bloomingdale's and Bluemercury. But overall, the consumer is still challenged. They still have inventory issues. And if you look at the overall performance, they did a little better because they had better operating, but the top line was down.
So, when I think about Macy's, obviously it is the quintessential department store. What's the strategy for Macy's going forward? Because it just doesn't feel like, and this has been a long-term trend for department stores in general, with e-commerce and so on, kind of a tough place to be. What's the strategy for Macy's these days, do you think?
So I think the reality is just a smaller footprint, a smaller company. I think it's shocking if you think about the fact that Macy's in the last 20 years has lost about 25% market share.
Wow.
And so
Is that to whom?
To basically retailers, Amazon, discounters. It's just a much smaller company than it used to be 20 years ago. And I think that if you think about the fact that they're going to close 150 stores, they're going to be left with 350 stores. It's just, I think that it's a tough place to be. I think there's still a place for it, and I think they can thoughtfully talk to those customers, but it's just going to be a smaller place.
To that point, what is their inventory functioning? Like, are they doing that well? Like, having a smaller footprint might be good in terms of inventory management. How are they managing that?
So from what I read, they were struggling a little bit trying to figure out the transition between spring and summer. Mm-hmm. So they did have a little bit of elevated inventory levels, but they seem to be doing okay. I think what they're trying to do is create more proprietary and special experiences, private label, things that you can't find anywhere else. But they need to hit it on the nose, and the consumer is being very picky right now about where they're spending.
You guys know why I asked that question, right?
Why?
Too much inventory means sales.
Sales
means
that's
Alix shops
Alix
there.
Yes,
Good inventory management means Alix does not shop there.
Right, I understand.
I'm not paying full price. But I ask that, I say that in jest, but it does speak to the promotional activity. And if the consumer is stretched and they're being picky, that's going to rely on the promotional world to kind of get them in the store to hope for more volume. Is Macy's part of that?
Yeah, I think what's interesting if you think about Macy's is that they're sort of taking this bifurcated strategy where on the one hand they have their own, the Macy's nameplate stores, and I think they're focusing on top doors, sharpening the inventory, sharpening the offers, and then they're going high end with Macy's and with Bloomingdale's and Bluemercury to try to attract that higher end shopper that's willing to spend a little more.
Rachel, I don't know if you're aware, but the big news in this studio over the last week was, for the first time ever, I went to a Walmart store over the weekend. Hugely impressed, blown away, everything, it is as you would expect. Because we had some Walmart earnings last week. What do you take away from Walmart? They seem to be doing pretty well.
Well, I think that you always have to look at the relationship between Walmart, Target, right? They're always head to head. And I think right now the consumer is feeling the financial pressure, they're feeling inflation, and they're trying to find deals. And what's interesting is there's still this perception that if you want to find lower price points, especially in things like food that are basic, you go to Walmart. Now, it'll be interesting. Now, yesterday, Target announced that they're lowering prices on 5,000 SKUs. And so
Really?
Yep.
how is that going to affect the dynamic between Walmart? You know, they're still trying, Target is still trying to keep that upscale image, that Target.
Yep.
But, you know, they're fighting for consumers that are really caring about every penny.
I mean,
Yeah.
I'm sorry. I was at 5,000 SKUs. I mean, how often does that happen? I don't think I've heard that too often.
I don't know if I know
okay.
that. I mean, I think that's pretty dramatic. Walmart has been lowering prices as well, so I think they're just sharpening the competition.
So they have actually already cut prices on about 1,500 items. And they had said that thousands more of reductions are planned over the course of the
They're
summer.
trying to get you into the store. I think.
Yeah, exactly, right.
Exactly.
One analyst over at Barclays was saying that these may have been planned as part of sort of the second quarter inflection that was embedded in guidance, and the second half maybe gets a little bit better. But obviously that's going to be a key topic tomorrow. Also, these items, though, we're talking about are milk, bread, soda, fruit, veggies.
Well, that's good because that's where I've seen it.
Yeah, but that's also, I wonder if that's a direct competition then to Walmart, because
Exactly.
that's where you can make an argument that if you go to Walmart for groceries, that's where you buy your other stuff, and I wonder if Target's trying to play with that.
Exactly. I think that it's sort of a double-edged sword. Target always tried to be like, you know, better quality, higher end, but still affordable. And I think what they're realizing is right now the customer's really focusing on the affordable, and they're really focusing on the basics. So they're going head to head on that piece.
Is there still too many stores out there, department stores or big box? I mean, particularly the department stores. I've always heard, like in the department stores, there's still too many stores in America. But now maybe the pandemic solved for that. I don't know.
Well, I think part of the challenge is, you know, Macy's did announce 150 store closures. So they're
that's
definitely,
big. That's big. Yep.
That's a big hit for them. I think a lot of it is, you know, when you think about stores, you also think about location and real estate and, you know, what are the top malls? There's obviously, you know, it's not just there are too many stores, it's that there are too many malls and people aren't going to those malls, but there are some shining places. So I think it's about like finding the winners and having a smaller, sharper footprint versus so many doors.
And it was interesting you say that, Paul, because some of these malls are being anchored by Target.
Yep.
So you also have to wonder if Target has to retrench a little bit here, what does that wind up meaning then for the mall? What would be good from Target when they report?
So I think the expectation is that they're going to be up slightly, about 1%, but we'll have to see. I mean, I do think that this news of better pricing is going to have an impact on them.
Meaning that would be helpful with volume, but then obviously not with margins.
Correct.
So
Interesting.
where do we go from here for retail? I mean, what's your takeaway on the consumer here? The consumer seems like it's, I guess, that K-shaped economy where some small percentage are doing quite well, particularly those that own assets, stocks, bonds, houses, and everybody else is really feeling the pain. Is that what you're hearing from the retailers?
Absolutely. I think that there is this sort of bifurcation of like the have and the have-nots. And so for some consumers, it's a small group, but they're very profitable. They're doing okay. They're still spending. They're still going to Bloomingdale's. They're still buying their Target. And for others, they're really struggling. And I think it's sort of come to that breaking point where when you start to see stores lowering prices, there's a real pressure from the consumer.
Yeah, that's a good point.
Yeah, but then obviously hurts the margins, and then it's like as a stock investor, you're like, well, do I like that volume versus margins? In your experience in the retail sector, which ones are kind of crushing it right now? Because it does seem to me that what names that people like are very targeted, right? Like a specialty retail store is the winner. Is that true?
Yeah, I mean, the first name that comes to mind is Sephora and how it continues to outperform. You know, there's a lot of talk about Sephora kids, but you're just seeing.
So what's a Sephora kid?
So a Sephora kid is my 12-year-old daughter who enjoys spending hours at Sephora.
Really?
But guess what? It means she buys, it means I buy. And I do think that there is an interesting approach where, you know, these Gen Z consumers that everybody thought, well, they don't really have that much disposable income, but guess what? They bring along others.
And have you ever seen the line in
Well,
Sephora over
here's
here?
my
Like
Sephora
there's
story.
always a long line.
Depths of the pandemic lockdown. I mean, ground zero of the lockdown. People in Sephora, A, they didn't close the store, and B, there were people in there I mean, triple masked up or whatever,
Oh, yeah,
but they
yeah,
were
yeah.
there,
Oh,
and
yeah.
they were in our chocolate store downstairs.
You know what we do, Paul?
What?
We invest in our face.
Yes, you invest
And
in our
that
face.
comes in many different forms, and one of
John
them
did
is
not get
makeup.
that memo back in the day.
After we
Wait, what are you
invest in our
saying?
face, we go eat chocolate, and that
Yes.
is what we do.
Okay, very good.
All right, good stuff. Thanks a lot. Really appreciate it. Rachel Ten Brink joining us, general partner over at Red Bike Capital. We'll see how those numbers wind up stacking up.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's talk Lowe's. I mean, I've been to a Lowe's. Now, I had not been to a Walmart until this past Sunday, but I've been to a Lowe's. I'm no John Tucker, but I
Sure.
know my way around a Lowe's. Drew Redding knows his way around a Lowe's. He's a home building analyst with Bloomberg Intelligence, joining us from Princeton, New Jersey. He forgot about the whole New Jersey Transit can get into New York City thing.
No,
That's a whole
apparently
nother
not
story.
today. It's really
Oh,
upset.
yeah,
Things
no.
have
Oh,
been
yeah,
broken down. It's
I
like
know,
90-minute
I gotta
delays.
I'm just ignoring it and hoping it'll be fine by the time I leave here. That's how I'm approaching this. Drew, talk to us about Lowe's here. Are people still kind of remodeling their basements?
Yeah, so the quarter was a little bit of a tug of war between sales and margins, and I think you're seeing that reflected in the stock today. Same-store sales were down about 4%, which was better than the 5 to 6% decline consensus was looking for. But part of that sales performance was due to the fact that there was a more promotional environment out there. If you think back to when Home Depot reported last week, they cited a late start to spring as something that muted sales. Lowe's actually said spring got off to a good start, and that has to do with them being more aggressive on promotions as part of their Spring Fest. And I think that really speaks to what we're seeing really across the retail landscape with the consumer, and that's that they're looking for value wherever they could get it. Now, they did reaffirm their full-year operating margin guidance, but that's going to require the company to execute on some internal initiatives in the back half of the year. Lowe's has made good progress in improving their margin profile, and them narrowing the gap with Home Depot has really been a key that investors have kind of, grasped onto. So the fact that they're taking a little bit of a step back here may be making some a little bit uneasy.
How much would the stock have to re-rate for investors and analysts to say, okay, fine, the margins are suffering, but at least the volume and the sales are there?
Yeah, well, the stock is still trading above, the 10-year average, even if you go back to prior to the pandemic. So from a pure valuation perspective, it's still a little bit elevated. That being said, I mean, if you take a step back, the move they've made on margins and narrowing the gap with Home Depot has been impressive over the last couple of years. So I think, the bulls would argue that this is kind of a one-off. And as we get to the back half of the year, margins start to improve as they implement some of their PPI initiatives. And in terms of sales, we're not expecting a huge rebound in sales this year. In the second half, comps will definitely get easier, but even Lowe's has stated that comps may turn positive, but that's not a reflection of an improved demand environment. It's strictly a reflection of easier comps. So we think as we get into 2025, that's when we would expect the market to see more of a turn as we get more of a rebound in existing home sales.
How about lumber? That's something they buy a lot of. How's the cost of lumber these days? How's that impacting their margins?
Yeah, lumber is about 10% of sales for both Home Depot and Lowe's. Lumber was really more of a story last year. It was extremely volatile, so you saw the impact on their top line there. Not so much of a story this year. I think commodities, particularly lumber, are going to have less of an impact in the near term.
So you feel like we're not going to really see a benefit until 2025. I mean, some analysts are looking for the back half of this year, maybe some improvement, but for you, it's really like a year out kind of thing?
Well, I think as we get to the end of this year, I think you'll start to see a little bit of a turn. And a lot of that is predicated upon with what happens in the housing market. Obviously, people are looking for the Fed to cut rates at some point this year. Obviously, not as much as we had hoped for previously. But we think that, when you look at existing home sales, we're, at the lowest levels in, more than 2 decades. So there's not a whole lot lower we can go absent, a broader economic decline where you start to see a lot of job loss. So we think that, if rates come in a little bit, you could kind of start to build a little momentum ending this year, carrying into next year. When we think, bigger picture about the home improvement market, there's some solid tailwinds out there. You have homeowners who are sitting on record amount of home equity. When you think about, the rise in home prices we've seen over the last several years, you've got an aging housing stock. And I think the fact that mobility has been so low because of those high interest rates is going to continue to encourage people to invest in their house. And I think what kind of triggers that is rates coming back in a little bit so you can start to tap that equity.
Drew, how many stores does Lowe's have, and are they adding stores? Are they paring back stores? Kind of where are they with their store count these days?
Yeah, so they're under 2,000. It's an interesting dynamic. So their competitor Home Depot is actually embarking on their first store expansion in a long time. Lowe's, on the other hand, has cut back. They got out of their Canadian business, which reduced their store count. But what they're doing from a store perspective is really introducing new formats. So they're starting to go after the rural customer. Their stores tend to be located in more rural locations compared to Home Depot, which are more densely populated locations, and they found success with that. So they're starting to compete more with the Tractor Supplies of the world. They're also introducing Lowe's outlets. So if you think of, appliances that might have dings and scratches, you could go there and get heavily discounted items, and that's another way they're looking to kind of drive traffic through the Lowe's brand.
Okay, now you're speaking my language. You put outlet there, and I'm like, boom, we will go find things that are cool.
I don't do outlets either.
You don't? Oh, I know you don't do outlets.
No.
That's my thing. Yep. It's just my thing.
Okay.
Even if I had $1 bazillion, I wouldn't pay full price. Part of the hunt.
Okay.
Yeah.
Right.
Anywho, so Drew, based on all this, if I wanted to play this housing market right now, what is the best play? And I say that because it's not like the housing market, that the demand isn't there, the supply might not be there, the costs are a little too high, mortgage rates are too high, but eventually it'll normalize. What's the best way to capitalize?
We think right now, kind of sitting at the top of the broader housing ecosystem is the home builders. We think, from a supply perspective, they're in a good position. Their ability to buy down mortgage rates and make payments more palatable to the consumers is something that differentiates them versus the resale market. They're going to grow community counts in the coming years. So we really think that they're still in a good position from a competitive perspective. And when you look at, within the home building space, you have the large, well-capitalized, publicly traded home builders who have access to land, access to labor, and you compare that versus the smaller private peers. And you have to remember, home building is a very fragmented industry, particularly outside some of the largest markets. But those smaller private peers tend to rely on regional banks for growth capital. And with, a slowing economy and more concern there, you're starting to see a pullback in lending. So we think it's a good opportunity for those larger builders to continue to take share.
Great stuff, Drew. Really appreciate it. Thank you so much, Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. I'm Alix Steele alongside Paul Sweeney and John Tucker. We bring you all the news in finance and economics through our lens of our Bloomberg Intelligence analysts. They cover about 2,000 companies, 130 industries worldwide. We also use this time to talk about stuff that Paul and I are interested in. So media, maybe some retail, maybe some sports, and maybe some energy. Joining us in studio is Dr. Jeff Chamberlain. He is CEO of Volta Energy Technologies. I don't know what that is, so I'm going to learn about it. Dr. Jeff Chamberlain, welcome. Thank you for joining us. What is Volta Energy Technologies?
Well, thank you, Alix, for having me. Volta Energy Technologies is a venture capital firm that we spun out of Argonne National Laboratory, which is one of the 17 Department of Energy labs and the lead in battery and storage tech and development for vehicles and for the grid.
So that means that you are trying to find good battery storage solutions that we can adopt on a cheaper scale.
Yep, that's
How's that going?
That's it, basically. And I'll tell you, the big thing that we've noticed is a couple of things. One is a lot of people are focused on the downstream device. Who's going to be the next big electric? Who's going to be the next Tesla? who's going to be the next Panasonic or CATL in terms of the battery manufacturing. But before I worked for the government, I worked in the chip industry, and we expect this to go just like the chip industry, where cost down will be king, and cost down will come from innovations in the supply chain and in the adjacencies. Things like fast charge, things like power electronics on board the vehicle, new ways to make batteries, all the way upstream to mining lithium. So while a lot of investors tend to be focused on those very downstream devices, the truth is lithium is king, and it will be for decades going forward. Just like oil and gas has been king for a century, just like silicon has been king in the semiconductor industry, and yet created trillions of dollars of wealth by modifications and wealth generation in the supply chain and in the adjacencies. So it's going well. We're finding a lot of good tech.
Where does lithium come from, and then how are you investing in that?
Yeah, if we go all the way upstream, let me start by saying that there is no better time for investors in the private markets, and this is a counterintuitive thought from what you read in the mainstream media, investing in the kinds of technologies that we're investing in, because the needs of the end users are increasing. And by needs, I mean lowering costs and improving performance. There's a reason 1 week ago today, the Biden administration put in tariffs that are 100% for electric vehicles coming from China. That happened because the U.S. automotive groups lobbied for that to happen. They know those cars will sell. A lot of the mainstream media says nobody wants to buy electric vehicles. They just leave off the second phrase, unless they're lower cost.
Right.
But when we go all the way back up to mining, it's notable what the big companies are doing. Last fall, after I was here talking to you, Paul, actually, Exxon announced that they want to become lithium suppliers. And the way they're going to do it is to leverage their own, downhole and refining capabilities, and to adopt and scale something called direct lithium extraction, or in my industry they call it DLE. It's a new way to extract and refine lithium, and it's like it sounds, it's direct. If you can remove process steps and use less water, use less energy, you end up with a lower cost production. So prices of lithium in the market have been fluctuating substantially these last 5-6 years, where the cost of manufacturing has stayed the same.
So where you guys would play in that, for example, like I know that's Exxon's investment, you'd be investing in the technology that would make direct to mining lithium work.
Precisely. In our fund one, we invested in a company called Summit Nanotech in Canada that is now scaling in Chile with one of the big lithium suppliers to supply that tech to lower the cost.
When you go when you go further up the supply chain, is that where it lands for you in lithium? You're not looking at like graphite or cobalt or other stuff?
Yes, thanks, Alix. They claim, Paul and Alix claim they don't know a lot here, but they clearly do. Yes.
Oh, no, I know a lot.
Energies are.
Who said that?
Maybe it was Paul. That's great.
Wasn't firm.
I'll speak for Alix.
That's just my Midwestern heritage speaking there, modesty. But the answer is we look at it all. Graphite, it's fascinating. Even graphite, there's not only a tightening on the supply, but it's mostly in China. So there's massive moves for the supply chains coming out of China being localized for cost reasons as well as geopolitical reasons. But we look at it all from graphite, cobalt, sulfur actually is a technology that can be used in batteries, lithium, and then downstream from that to things like new microchips that enable power control and can lower the cost of electric vehicles.
Do we need to be concerned about the security of the resources for all these electric vehicle components? Like, are they in China that's a risk, or are there in parts of the world where it's a risk to the U.S. and others? Is that a risk?
The short answer is yes. There's a longer, more nuanced answer. Graphite and lithium in particular, depending on which material you're talking about, 80 to 95% of it's processed in China, but it's not sourced in China, which means there really is an opportunity, especially with the advent of technology that lowers manufacturing costs, to move that supply chain out of China because the resource itself is not in China. However, magnetic materials, the core called rare earth elements that are used in magnetic materials for electric motors, most of that is in China. So there's been a 10 to 20 year research effort in the Western world to develop new magnets that don't require rare earths, and those are all going to be coming commercial in the next 3 to 5 years as well.
I was talking to a graphite producer yesterday.
Who doesn't?
And he was talking about the tariffs that were put on. I know you mentioned EVs in particular, but then the nuance of, say, the raw materials going to Canada or Mexico And then because we have a free trade agreement, they just come into the U.S. And so there's a huge price discrepancy versus, what you're willing to pay for localized materials versus how cheap China can get it. How do you solve for that? Because that's really going to be about lowering the cost, which is really technology, which is really you.
It's really a good question. And I'm not being a politician, I don't know how to handle it from a policy perspective, because there are loopholes that you can go through in Mexico and Canada, et cetera. Ultimately, the answer is things like graphite. There's graphite all over the world. The largest graphite mine in North America is in Bécancour, north of Montreal, and that's natural graphite. There's also something called synthetic graphite, where you can manufacture the graphite from carbon, and there are big oil producers that are looking at doing that as well, right, to grow their business in that direction. So in my view, as a technocrat and as a technology investor, it is find the innovations that can lower the cost for localized supply. And I think there'll be bumps in the road between now and adoption of that technology in terms of what's happening worldwide geopolitics, but I think ultimately it's localized supply that will win the game.
Where does Mr. Tesla get his batteries? Where does Elon Musk get his batteries for his cars?
I used to joke on Capitol Hill when I worked for the government that if you peel the T off the factory, the Gigafactory in Nevada, you see a big Panasonic logo underneath it. Originally, it was a Panasonic deal that they cut and embedded themselves together in the supply chain. They since have expanded to LG and CATL and others. So CATL is the big dominant battery supplier in the electric vehicle supply chain, and that's in China. But they've onshored manufacturing, right. And as an American citizen, I don't think it's a bad. Even before IRA became enacted,
right.
Panasonic, LG, Samsung, they'd all announced 20 gigawatt hours of manufacturing in the U.S.
All right, Jeff, thanks so much for joining us. Dr. Jeff Chamberlain, CEO, Volta Energy Technologies, joining us here on our Bloomberg Interactive Broadcast.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We make sure you're up to date on all the news that you need to know in business and finance. We have great analysts that cover 2,000 companies in 130 industries worldwide. We also have a huge staple of reporters all around the world. And we're going to go to one of them now on this story. So apparently, ASML and Taiwan Semiconductor Manufacturing, so TSMC, have ways to disable the world's most sophisticated chip-making machines in the event that China invades Taiwan. It's basically the idea of here's a kill switch. You press a button and all of a sudden those machines stop working.
Really?
It says something, right? Isn't that sound
very techy?
Doesn't it, though? Yeah. Let's get to the guy behind the story. Diederik Baazil joins us, Bloomberg Dutch Government Reporter. He joins us on Zoom from Amsterdam. It's a real pleasure, and I know you're staying up late for us, so thank you very much as well, or working late for us, I should say. Walk us through this story. What do we know?
Hi, yeah, thanks for having me. Yeah, what we reported exactly is that ASML has a so-called kill switch, and it can use it on its most sophisticated machine. That is the EUV machine, or the extreme ultraviolet machine. And this basically means they can kill the machine remotely when they choose to. And this capability was indeed discussed in the context of a possible Taiwan invasion, and was discussed at least with the Dutch government. So yeah, it's an important capability in a very sensitive geopolitical context.
So I guess it sounds good. I mean, from your reporting, is there a belief that this really can be achieved? Because it sounds like something that could be, I don't know, hijacked or something. It seems like it's too good to be true.
Yeah, so the thing is, ASML has contact with its machines to do updates the machine need anyways. And this connection they have can also be used for this capability. So it's not a built-in kill switch, but it's a capability that can be used for different purposes. And yeah, what we have heard is that ASML has told government officials that they can do this if that is what they decide to do. So. Yeah.
So I'm assuming, though, that officials, say in China, might not like that. Is that a legal thing to do?
Yeah, it's like an invasion is also not really legal, I guess. So if we end up in such a context, you need to ask different questions. But yeah, that's the context we're talking about. If an invasion would happen, then this is a possibility.
So, but I guess to date, China is still ASML's biggest market, isn't it? Even after some restrictions?
Yeah, close to, yeah. Like TSMC is the biggest client, but China as a country is definitely a big market for ASML. Yeah.
So what are some
But
options
not for this machine though. Not for the EUV most sophisticated extreme ultraviolet machine. That machine isn't allowed to be exported to China.
Ah, okay. So do the machines that ASML does export to China, does that have this quote unquote kill switch?
So we're talking about the EUV. So that's the most sophisticated machine, and you have plenty of them in Taiwan, and that's why it's essential that this capability exists in the context of the Taiwan invasion. But ASML has been subject to export control for a while. They have been pushed by the US, and they have been mostly focused on these EUV machines, the most sophisticated ASML chip machines, and you need those machines to the most sophisticated chips you need for any AI development or any military purpose. And those machines aren't in China at the moment.
These machines aren't cheap, are they? What's one of these big chip making machines? What do they go for?
Yeah, so this EUV is, I think it's about like 200 million a piece.
Oh,
something like that. Yeah.
And ASML does something very unique, not very unique, they do something unique in the semi space, right? You can also license, it's a lithography, right? It's like the machine you need to make the chips. Can you walk me through what exactly that company does and then why it becomes so important to the sector?
Yeah, so basically ASML is the only company able to make this machine. And like older generation chip machines, you have more companies that are able to make those. But to make the best chips with the lowest nanometers, you need for, like what I mentioned, AI. Those machines you need for those chips, ASML at the moment is the only company that can make them. So yeah, then that gives them an important, massive market position. And yeah, you also end up in a geopolitical struggle as we see right now.
Yep, absolutely. All right, Diederik, thank you so much for joining us. Diederik Baazil, Dutch government reporter for Bloomberg News, joining us from Amsterdam via Zoom. Again, ASML, TSMC, big chip makers. Apparently they can disable chip machines if China invades Taiwan. You think about that cybersecurity, and it just kind of goes to the issue of this, what seems to be a growing technology Cold War between let's call it China and the West, broadly defined. I'm not sure how you do that, but again, governments are making plans. Companies here, we see from this reporting, are making plans, but...
Well, this also dovetails with Volta Energy that we spoke to in the last hour. So that company makes investments in technology that can help reshore the supply chains for batteries and storage, right? So think like lithium, how to extract lithium more cheaply and more cost efficiently. It's all part of the same story. How do you decouple after a few decades of coupling when you're a company, whether it's tech, whether it's rare earths, whether it's another asset? As a CEO, how do you capital allocate from that, right? Like some companies like a Caterpillar, they make their stuff there. Train Technologies, for example, it's an HVAC company. They make stuff in China and sell to China, right? So their China sales might be fine, and then maybe you're insulated. But otherwise, I would think it'd be very, very difficult.
Yep, and one of the companies that I think, when I think of just China risk broadly defined, I think of Apple. I mean, it's 20% of their sales go there. It's obviously a huge growth market. It's also critical to the supply chain, as we just kind of learned a little bit here from Diederik's reporting in terms of where the chips come from and where their hardware is manufactured in China. If you're Tim Cook, boy, I don't know how you manage that. I guess you just kind of
go to India.
You go to India, but that's going to take a long time, as we're told, to build that whole infrastructure out. But I guess if you're Tim Cook, you go to China as often as you can and try to, just try to keep a good, I guess, dialogue going with the government officials there to keep the status quo going.
Yeah, and we were talking about that when we had a great story about maybe Tim Cook and the succession plan and sort of, do you need a full-time China ambassador basically as a company, you need to have someone who can really help secure that relationship. In addition to all the other stuff like capital allocate, return dividends, like do the things and innovate.
His job, Elon Musk's job, who's also got a lot of exposure there. CEOs. Jamie Dimon has been over there recently for JP Morgan Chase. So a lot of CEOs, going over to China, trying to, I guess, maintain decent relationships in the face of governments.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's go to the bond market here. We are seeing a little bit into the bond market. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, is joining us. Ira, the market supposedly, the narrative is that it's waiting for NVIDIA. What does the bond market do with NVIDIA?
I don't know if the bond market's going to do a whole heck of a lot with, story stocks in particular. But the bond market is, still waiting for the Fed. We have a ton of Fed speak this week. We have the minutes coming out tomorrow. So the bond market's going to kind of be on edge as to, when the Fed's going to cut. How do they see the balance sheet shaping up? And, we've had a lot of speakers. Like I literally, just before walking on, we finished up with Governor Chris Waller, who, gave not anything significantly different than what Jay Powell's been saying, but certainly some details that, have people talking about the future of monetary policy and things like what is R-star, what is the neutral Fed funds rate, and where should it be given the current environment.
All right, for all the listeners and viewers out there who maybe don't have a Bloomberg terminal in front of them, one of the most widely used functions is ECO, EcoGo. It gives you a nice list of all the economic data that's released by the government so you can stay on top of it all. And of course, on there is for tomorrow, FOMC meeting minutes. My question, Ira, is who cares? Because we hear these Fed people speaking all day, every day, except for like a 15-minute blackout every quarter. Do the minutes really tell us something since these folks are always speaking anyway?
It does, and it tells you a couple of different things. I mean, firstly, it tells you the entire committee, right? Because there are certain people who speak more frequently in front of the media. For example, Raphael Bostic of Atlanta Fed, he's on TV all the time, right? He was on Bloomberg Television not so long ago, like yesterday. We also have Chris Waller speaks a lot. So it gives you all 19 members' view, and then who believes what in a more succinct fashion than you can maybe glean from a lot of the Q&As that wind up generating a lot of headlines, but it's hard to kind of get a complete narrative of what everyone is thinking. So I think that the minutes are useful. They're also useful from an analytical perspective. What we use the minutes for in determining where we think the future path of policy is going to be is we compare what's being said to other periods. And when so we actually have a model, a natural language processing model that says the Fed is hawkish and dovish. And the nice thing about the minutes, it says a few members, most members, some members. And we're able to get an idea about how many members have that view, which is not something you can get from the post-meeting press conference, which is not something you can necessarily get from just listening to 3 or 4 or 5 speakers instead of all 19.
All right, so that's kind of where I wanted to go.
It can be pretty helful.
Ira, I saw in your research, which I do read, despite all other.
Despite what?
Yeah, I read it begrudgingly because it's great stuff in there. Natural language processing model you use for the minutes. What is that all about?
Yeah, so our model basically takes every sentence that it has to do with monetary policy and the economy within the minutes. We also do the same thing for the post-meeting press conference for the prepared remarks that Jay Powell makes, and tries to determine whether or not it's a little bit hawkish, a little bit dovish, neutral, or very hawkish or very dovish. And in doing that, we can then weight it, right? That's the advantage of the minutes over some of the other models that you can potentially use that are similar, where the minutes have other indicators. For example, it says a member thinks, which means one person, right? Whereas if it says many members think, then that's less than half, but more than a couple, right? More than 3 or 4. So you wind up with probably a better overall gauge of how hawkish or dovish the Fed is. And what our model shows right now is, as of the last meeting minutes, which will probably remain the same this week, presumably, is that they're very neutral. They're basically right in line with what would be an on-hold Fed. And that's very consistent with what we're seeing. Now, I suspect that unless the economic data deteriorates or improves very significantly, like you see an uptick in inflation, that the Fed will probably remain in that neutral territory with a little nuance there, which just means that they're going to be on hold. And Chris Waller said today that he thinks that rates are going to be on hold at least until the fourth quarter. Bostic said the same thing. So those are indicators that the minutes have, at least are in line with the other speakers that you hear in the media.
Bostic talking up neutral and sort of what is neutral. I feel like Jay Powell in the last press conference really didn't take that bait. How do you view what the neutral rate is, and how important is that to the conversation right now?
Well, so ex ante, it's very difficult to determine what the neutral rate is, right? Because you don't know what the propensity for people to take loans are, and how high or how low interest rates need to be versus inflation or some other measure for where interest rates are going to not increase inflation or decrease inflation. And there's really realistically no way to know that, which is the reason why you get these cycles. The idea, though, and I think this is what everyone in academic land and rate strategists all over the world are talking about, is given how low we think the neutral rate was between 2010 and 2019, has that moved up? And the answer is unequivocally yes. It had to, right? We're in a tighter labor market environment. We don't have the same type of globalization pushing down goods costs that we had 10 years ago. So all of those things are probably true. The problem is nobody really can guesstimate the magnitude. There's a lot of models to do that. Is it 2.5%, which is kind of what the Fed seems to think that it is based on the dot plot. Some people think it's a bit higher than that. I actually think it probably is a little bit higher than that. But there's no realistic way to know beforehand exactly where R star is. But you have to guess if you're a member of the Fed or any central bank, because otherwise you don't know. Are we restrictive or are we not? I'd argue that the Fed probably is modestly restrictive, maybe not restrictive enough, but they are certainly more restrictive than they were when interest rates were at zero.
Hey, Ira, I'm just looking at the 10-year Treasury. Just in the last, 3 to 4 weeks, it's kind of come down in yield from 470 range down to about 440. Does that tell us anything, or is that just kind of trading within a range?
Yeah, I think we've hit that range. We talked, I think it was last week, Paul, where we were mentioning on that kind of 430 to 450 might be the new range for now until we get a significant regime shift. It's not telling us much of anything except that, again, the market is still pricing for the Federal Reserve at some point in the not too distant future will be lowering interest rates. And that's why you have the continued inversion of the yield curve where the 10-year yield is lower than the 2-year yield. But even that has contracted quite a lot, right? That was as much as 100 basis points between the two, and now it's less than 50. It's 40-ish basis points right now. So that's just saying that at some point the Fed's going to cut. When the Fed cuts, 10-year yields are probably going to rally a little bit, but we're already priced for at least part of that cutting cycle.
All right, Ira, thanks a lot. We really appreciate you. Thank you very much, Ira Jersey, Bloomberg Intelligence Chief, U.S. Interest Rate Strategist, joining us there.
And the way to get all that research, Alix, is BI space RATE. BI rate will get you to all the interest rate analysis for Ira Jersey and his team on a global basis. You pull up, there's stuff about Canada, there's stuff about Asia, China, in all different languages on this dashboard, but it is the global view of interest rates.
And you can't beat them. You just really can't. You can't be the model that goes through and looks at speeches. You just can't beat that.
No, who's got large, a language model? I don't know.
It's
well, there's also Mossad, the Israeli intelligence agency, uses a very similar type of software to look at conversations that they intercept. We use the same thing for conference calls and. Well, yeah,
see sentiment, yeah.
Just to look for keywords and whatever, so you don't have to sit there and listen to the whole thing.
Well, I listen to conference calls all day. What are you guys talking
I
about?
spent a career doing it.
I mean, come on.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.